Assalamualaikum to Dr. Nurhuda binti Niza. We are pleased to present our group assignment for Corporate Finance FIN537 on the merger and acquisition case. Before we begin, let me introduce our group members, which are Adriana Balisha, Nurain Zulaika, Nora Ashikin, Nur Izazi Atira, and myself, Shahidatul Adriana Natasha. To start, mergers and acquisitions or M&A refer to strategies where two companies combine operations through a merger, or when one company takes over another through acquisition to achieve growth, broaden market reach, improve efficiency, and strengthen competitiveness. Our presentation focuses on Maybank's acquisition of Kim Eng Holdings, which is one of the most significant M&A cases in Malaysia's banking sector.
Next, I will be explaining the types of mergers and acquisitions, also known as M&A, for Maybank and Kim Eng. For Maybank and Kim Eng case, in January 2011, Maybank, Malaysia's largest banking group, successfully acquired Kim Eng Holdings, which was one of Singapore's largest stockbroking companies at that time. This acquisition was carried out through a friendly takeover and can be classified as a horizontal merger, as both companies operated within the financial and investment banking sector. Maybank initially acquired a 44.6% equity stake in Kim Eng and later made a mandatory public offer to acquire the remaining shares. This process allowed Maybank to gain full control of Kim Eng. The acquisition was completed smoothly, with no resistance from shareholders, as both parties share a common strategic vision. The main objective of this acquisition was to strengthen Maybank's stockbroking and investment banking capabilities and to expand its presence across the Asian region. Kim Eng already had established operations in key markets such as Singapore, Thailand, Indonesia, and the Philippines, allowing Maybank to scale its services quickly without building new infrastructure. Following the acquisition, Kim Eng was delisted from the Singapore Stock Exchange and became a wholly owned subsidiary of Maybank. The combined entity was later rebranded as Maybank Kim Eng, positioning it as one of the leading investment banking firms in Southeast Asia. In conclusion, Maybank and Kim Eng acquisition demonstrate how a well-executed M&A strategy can support regional expansion, enhance capabilities, and drive long-term growth.
A merger is when two companies combine into one, while an acquisition is when one company buys another. Acquisition can be friendly, hostile, or reverse. In 2011, Maybank acquired Kim Eng in a friendly horizontal merger. The main reason for this acquisition were: first one is to strengthen investment banking and stockbroking. Maybank wanted to boost its capabilities quickly without starting from scratch. The second one is regional expansion. Kim Eng gave Maybank access to the Asian markets, especially Singapore. The third one is revenue diversification. Maybank aimed to reduce reliance on interest income and increase non-interest income like brokerage and trading fees. For Kim Eng, the acquisition means access to Maybank bigger funds, stronger brand, wider client base, and better system, helping it grow faster and more competitively. In conclusion, this acquisition was a win-win. Maybank strengthened its business and expanded regionally, while Kim Eng gained resources and credibility. It shows how M&A can drive strategic growth in a competitive market. This analysis is going to be the company's short-term solvency, which is how many of their short-term liabilities they can pay off. Kim Eng was showing strong liquidity even before the merger, with current and quick ratio at 2.03 times. It is in a good position to pay off its debts. But Maybank was not good in that their liquidity ratio of 1.25 times left a shorter buffer to its short-term payables. After the merger, the combined Maybank Kim Eng improved their ratio to 2.15 times, showing that the merged entity is now stronger and more improved in handling short-term liabilities. Overall, the merger strengthened the company liquidity and financial stability.
Now, let's look at the profitability ratios before the merger in 2010, which show how Maybank Investment and Kim Eng performed individually. First, the net profit margin. Maybank Investment recorded 41.48% compared to Kim Eng's at 21.41%. This shows that Maybank was more efficient in controlling costs and converting revenue into profit. Maybank's strong operating structure and backing from the group give this advantage, whereas Kim Eng had higher operating and brokerage expenses. Next, the return on assets or ROA. Maybank Investment achieved 6.47% while Kim Eng had 4.58%. This indicates that Maybank was slightly more efficient in using its asset to generate income while keeping a relatively low-risk asset base. Lastly, the return on equity or ROE. Maybank Investment recorded 31.60% compared to Kim Eng's 8.77%. This means Maybank provides stronger returns to its shareholder, reflecting better capital management. Overall, Maybank had higher profits while Kim Eng showed efficiency in asset use. These differences were complementary, making the merger a strategic move to combine strengths and enhance long-term performance.
Next, I will be explaining about leverage ratio. The acquisition of Kim Eng by Maybank Investment marked a clear strategic shift and delivered strong financial benefits. The debt-to-equity ratio fell sharply from a risky 3.81 times to a healthier 0.81 times, strengthening the equity buffer and insolvency protection. Financing shifted from debt to equity, while the merger improved resilience against ASEAN market fluctuations and expanded regional reach. The interest coverage ratio rose 29.62 times. Maybank contributed a strong capital base and lower cost of debt, while Kim Eng added high-margin brokerage income, together improving operating profit and overall creditworthiness. Maybank Investment's lower price-to-earning ratio reflects its maturity and stronger reliance on the Malaysian market. In contrast, Kim Eng's higher PE shows that investors were willing to pay a regionality premium for its established ASEAN presence. The market viewed Kim Eng not just as a brokerage but also a growth platform positioned to benefit from expanding wealth and capital markets in Singapore, Thailand and also Indonesia. This higher valuation is also evident in its EV/EBITDA. By acquiring Kim Eng instead of building regional operations from scratch, Maybank paid a control premium but achieved strong earnings accretion, demonstrated by the tripling of net income in 2012.
The synergy between Maybank and Kim Eng has delivered exceptional financial results. In 2012, the integration achieved a high operating margin of 53.5% and EBITDA margin of 51.1%. This figure highlights a massive boost in efficiency, with operating profit growing by 71.1% annually for outstripping revenue growth. This success stems from two areas: revenue synergy, driven by a broader regional network, and cost synergy, achieved by unifying system and infrastructure. Simply put, the combined business is significantly more profitable than two entities were on their own.
As shown in the table above, Maybank Investment Bank recorded an exceptionally high return on invested capital or ROE of approximately 38.6% in 2012. This indicates that the bank generated nearly 39 cents in after-tax operating profit for every 1 ringgit of capital invested, which is significantly higher than what is typically achieved by commercial banks. This strong performance demonstrates that the bank was highly profitable and capital efficient, creating substantial value for its shareholder. The bank fee-based investment banking and brokerage activities enable it to generate strong earnings without requiring large amounts of capital, contributing to its outstanding ROIC performance. The EPS growth in 2012 shows that the merger more than doubled profitability capacity, proving it was not just an expansion in scale. Despite issued shares remaining at around 50.1 million, higher net profit meant shareholders gained more value with the ownership dilution. The strong EPS growth also nearly doubled reserves, directly strengthening the balance sheet. Retained earnings increased net asset value per share and provided a stronger financial buffer. Overall, this performance enhanced shareholders' value while significantly improving the firm's ability to pay a higher dividend.
In conclusion, the acquisition of Kim Eng was a masterstroke for Maybank regional ambitions. It transformed the bank into a regional powerhouse with a direct presence in 8 countries. The financial impact was profound. Return on invested capital reached 38.6% and earnings per share surged fourfold to 439 cents. By combining Kim Eng investment banking platform with Maybank commercial strength, this merger successfully secured Maybank leadership in the Asian market and created a rock-solid foundation for future growth. That's all from us. Thank you.